Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another episode of Bell Curve. Today I'm joined by friend of the pod, Hasu, and first-time joiner Konstatin Lomashuk of Lido and Cyberfund fame. Guys, welcome.
Hi, Mike. Thanks for having us. Hi, Konstantin.
Hey, guys. This is going to be a really fun episode. So we are going to be talking all about Lido v3, which was just announced today. And I want to caveat up for listeners as well. Hasu and I actually did an episode back in December where we laid some of the groundwork and we discussed Goose 2 and some of the just dynamics that are going on in the liquid staking ecosystem in Ethereum and how that led to this new design. We're going to do a quick overview, but if for folks that want to go deeper, we're going to link the episode in the show notes, and I highly recommend that folks go listen to that episode. But in terms of an agenda for this episode, we're going to do a little bit of an overview of Goose 2 and sort of the strategic rationale that led to V3 for Lido. Then we're going to talk a lot about V3's design, what is public today, and then we're going to zoom back out a little bit and widen the aperture and discuss how this fits into the broader context of Ethereum today. But Hasu, could I call on you a little bit as the author of Goose for Lido? Just give us a little bit of an overview of sort of state of the union on liquid staking in Ethereum and how Lido is thinking about the world.
Yeah, sure. So I think the most important thing to know is that when Lido launched, Lido is a liquid staking protocol. And back then, the expectation was that liquid staking is by far the most dominant, best form of staking because you get full liquidity on your stake, and it's very decentralized, non-custodial, and like all of those nice things. And the liquid staking market was, like the staking market itself was growing as kind of, more and more money flowed into the beacon chain, and people wanted to secure Ethereum and get access to yield, and that became more and more de-risked over time. And like inside the staking market overall, also the share of liquid staking was kind of growing at a very steady pace every year for many years. And Lido was, always the leader in the liquid staking category. So right now, like looking at all of liquid staking and liquid restaking, Lido has around 70% market share in that category. However, like about 2 years ago, the liquid side of the liquid category side of the market has started to stagnate and lately even reverse a little bit. And so kind of the trend that we saw was that there were like illiquid forms of staking that all of a sudden like became much more popular. And when we kind of did the analysis on why that is, it turns out that liquid staking is a very kind of homogeneous form of staking. Like, everybody kind of gets the same token, and that is kind of that stake is spread across like many different operators that all do roughly the same thing, right? And get roughly like the same reward. And it turns out that there was I would say like a big kind of fragmentation in what the users wanted out of their staking provider. And so much more kind of customization. I think you saw the rise of restaking. I think that was a big topic. Like more kind of validator sidecars that are starting to be created, with, you used to have none, then now you have MEV Boost. There's Commit Boost that's in development. You have like 5-6 different clients around pre-confirmations and like other types of validator commitment that, people may want to experiment with. You have DVT providers, and like all of these are also kind of, giving points or some kind of, inorganic incentives. And so really like you see that the demands, like there's a lot of demand to use a lot of different things. And Lido v2 up to this point has really been like a one size fits all solution. Similar thing can be said about the institutional market. There are like a lot of folks are basically fine using staked ETH as it exists today, but then some other parties have like other requirements, or like they want to exactly select who their node operator is, or like they have a very specific requirement for what relays can be used in the MEV market. Like there's basically, you know, these kind of constraints that like Lido, being a kind of one size fits all solution, was not able to serve very well. And this was the major, this is the one central strategic insight behind Goose 2, that really Lido must become a platform in the same way that Uniswap became a kind of a platform with like V4 and hooks. It must become a platform on which like a very diverse staking market can be built, but that all kind of tap into the like extremely strong, like broad liquidity and distribution and integration of staked ETH as the kind of feature that ties it all together. And so I would say that is kind of the backdrop, from which we're kind of coming. And happy to, Konstantin, if you have kind of anything to add to this, like just laying the groundwork.
Yeah, I think that the main important thing to understand that Lido was launched as a mission-driven, decentralized autonomous organization. And the main mission is to make Ethereum decentralized, or keep it, because it's already great, and always were great, and are more, and also like censorship resistant. Why? Because staking was complex from day one, and in general, we would like to made it simple with their mission, to keep it decentralized. And with the Goose, proposal, because it was some challenges, in the market, in general, we commit to continue focus on our, not, on some short-term business objectives, like for example, restaking but keep, driven our mission, focus on dual governance, to keep it and make it more secure, to make it more decentralized by accelerating more validators, and also keep, growing maybe like market share, because, that is a primary solution. And in general, that is a big bet that, if we deliver the mission, Lido will be in general in good position.
Today's episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger is trusted by 7 million users, secures 20% of the world's digital assets, and remains the most secure hardware wallet for your crypto and logins. Follow the link in this episode's show notes to grab your Ledger today. I really like this analogy of, there's a couple of different verbiages which really resonate with me. It's this sort of transition of stETH to a product line. But also, I really like this idea of like a platform business model. And so, can we just get into maybe starting to describe or sketch some of the outlines of V3? Who are the different participants in this marketplace model, and then we can get into some of the key decisions around the architecture.
Yeah, maybe I will start here. So first of all, we need to go to V3. We need to understand where is Lido. And I think where is Lido today is, first of all, like the biggest DeFi protocol by TVL, second, it is made Ethereum decentralized from day one of proof of stake. And in general, it's committed to some plans, or in general, some features, and consistently delivering these things, and we need to understand it, for example, back when Lido started, it was just permissioned validator set, but it was already better than if we will not have it, why? Because when proof of stake on Ethereum started, it was no even professional validators that want to launch on Ethereum, I've spoken with a lot of them, because I'm also co-founder of P2P.org, because in general they need to build special software, special smart contracts to be self-custody. And in general, a lot of professional validators, they don't want to be a custody of the assets, and they didn't have own ETH. And in general, Lido solved it, because, for the user, it was better to go to centralized exchange, And for centralized exchange, they provide this, like service from day one, like Binance, Coinbase. And also it's even more profitable for the acquisition of these users, because LTVs, lifetime value for their acquisition of such user for centralized exchange is much higher than, for example, for professional validator. And Lido came to all the biggest validators, like, and say, let's build something together. In general, let's build a software that in general will decentralize and keep Ethereum censorship resistant. And in general, from day one, it started to make big job in the decentralization. And then, like we delivered, like for a lot of different features, like some of them, for example, we push in production, like DVT with partnership with SSV and Noble, like it is also like Lido delivered CSM, a community staking model that now made Lido permissionless, like, and now, like already our Lido is not like this 5 validators that started. It's more than 600 different node operators. And that's all in general making Ethereum more decentralized. And also, in this quarter, Lido will deliver dual governance that solve engine problem, like that Lido token holders can't manipulate this middleware and stETH can block it, like that is a huge thing. Why? Because, like we really believe that people can write some middleware, some smart contracts, that will solve some issue, and in general mission driven, and in general Lido achieve it. And what is Lido v3 is we want to make it even better, like we in general solve liquid staking, and we are going to a new market called Ethereum staking infrastructure. As I told you, like in the beginning, all the staking providers who want to run the node, they had an issue. They need to write a software. They need 32 ETH. They need some other like complex setup. And what is Lido want to introduce staked vaults, in general, a setup that you can deploy to the Ethereum and run your own customized staking or not validation service. And also in the same time, you can leverage, like if you don't have 32 ETH, you can launch it with low amount of ETH. You can choose who stakes with you. You can choose a middleware that you can use, like MEV Boost, like pre-confirmation, and so on. And in the same time, to mint stake this, I think it's a game changer. Why? Because it can make Ethereum more decentralized, more censorship resistant, and even more node operators can join Ethereum to run nodes, and in a more simple way.
So, Hasu, I want to kick it over to you here in a second, but Konstantin, you said a lot there, and just to unpack it maybe and provide some analogies for listeners is, I think that like the early instantiation of Lido was you're kind of this two-sided marketplace in between stakers and node operators, and you described some of the very early frictions there, just around, there was no software to actually support connecting these two market participants, and that's what Lido did extremely well in the beginning, and found really successful early product market fit. I would guess probably with some combination of mostly a lot of retail probably, but also a lot of some institutional stakers that maybe were in different jurisdictions or had lower, some group of institutional stakers that had, some specific set of requirements that allowed them to do this. But now as the marketplace has evolved, right, it's become more mature, and maybe Lido has achieved, kind of saturated its original market. It's transitioning to more of a platform model so that it can satisfy a more heterogeneous group of customers. I would guess mostly in this instance, institutional stakers. And I think we can draw analogies here as well to, we've talked about Uniswap doing the same thing with V4, where they evolved from a pretty simple interface where you could swap ERC20s in V2 to becoming more complex over time, provide concentrated liquidity. And now it's a platform model where they're basically creating a marketplace for AMM designers, right? There's a huge variety of what they can actually offer on the AMM side. Morpho is an analogy here as well, where kind of like Aave feels more like a managed product in terms of, one size fits all risk return profile, whereas Morpho is much more modular. And so maybe that's kind of laying the groundwork here for, maybe adding a third participant into Lido here, or the Lido marketplace, which is coordinated around this neutral infrastructure, which you were describing, Konstantin, which is, there is the node operators, there is stakers and institutional stakers becoming much more important here. But also there's maybe this new participant, which is asset managers and this concept of curators, right? And I want to introduce this concept of ST staked vaults as well. So maybe Hasu, you can go a little bit deeper and describe some of the mechanics here around this platform transition and what it looks like.
Before we go there, Konstantin, do you have anything to say on like the curators and asset managers? Maybe you can ask that first, and then afterwards I can explain like the mechanics.
Thanks, Hasu. You know, like I think, Michael, you know, like this analogy is really super close, you know, like for what we mean here, you know, like, and first of all, you know, like I want to say that stETH already works well for a lot of people. First of all, you know, like it works well for Ethereum. Why? Because it's decentralized in Ethereum, you know, like, and in general make it censorship resistant. Second, it's worked well for a lot of users. Why? Because they can stake and diversify the stake between a lot of validators and contribute to decentralization, and also use it in DeFi and stake is the most liquid asset, you know, like if we look on any other staking solutions. And also, you know, like 25 or 5% of, you know, like stETH is already used by institutional. So it's already covered a lot of these use cases, you know, like it's still some edge cases, you know, like why in general, maybe, I mean, in general, liquid staking is about 30% of market share, you know, like, and it is still like a lot of different other staking use cases, you know, like, and what we try to say is that we need customization, and it is different, you know, like use cases where, for example, the staked walls can run by Curator or like by institutional. I mean, for example, it can run in Coinbase custody, you know, like, and in the same time give all the, you know, like setup of the jurisdictions that you need as a user, as a client, you know, like, or as a validator, and launch, you know, like staking, and also at the same time get liquidity through minting staked ETH from these vaults. Yeah, Hasu, maybe we'll give you a microphone here.
Oh, sure. Yeah. I mean, I think Konstantin was already kind of laying it out, but in my mind, there's two components to Lido V3. One is the staking infrastructure side of things. So, I mean, making it very easy for anyone to launch a non-custodial staking setup that they can use exactly to kind of implement this market, Mike, that you were talking about, right? Between node operators and people who want to stake. And with the difference that it's much more customizable than it's ever been in Lido to date. Okay, so you can really implement any kind of staking setup that you want. And then the second major part that you know, the audience kind of can understand, I would say, is the liquidity layer. So you have the staking infra, and this allows you to make a rich kind of you know, garden of like different staking vaults, different staking setups. And then what the liquidity layer allows you to do is the ability to still mint staked ETH against these vaults, like you're participating in Lido itself. Like you can make a very custom setup, and then, you know, maybe you stake 32 ETH in that custom setup. And, you know, then maybe you can still mint like 27, 28 staked ETH against that. So in Lido V2, you know, you can mint staked ETH 1-to-1. Why? Because the protocol like very tightly kind of controls the way that the stake is being used, and like what kind of software the different node operators run, and like over like how many, you know, it is distributed, and what geographies they're in, and what client they run, like all of this stuff, right? And as we kind of move to a more diverse, more heterogeneous staking setups, then Lido will give you the ability to kind of tap into this like best-in-class liquidity and integrations, but at like a slightly lower collateral ratio.
Yeah, this anticipates maybe one of my questions getting under the hood here a little bit. You know, in the past, when we've talked about Lido pretty extensively in the liquid staking season, we discussed V2 and the staking router. We described exactly this, right? There was basically, you can consider a whitelisted set of node operators that Lido would sort of programmatically apply stake to as it comes into the platform. And you know, the benefits that you get there is very tight risk controls, right? You can sort of imagine that as a a big benefit of just the sort of Lido infrastructure that underlies that set of decision making. And one thing that we talked about a lot in that season was the benefit to stETH of fungibility, right? So it doesn't necessarily matter. You're not having a one-to-one relationship with any one validator. So, a stETH is a stETH. But now as we introduce this more modular setup where you can essentially bring your own validator, and that's who you're sort of KYC'd to if you're an institutional staker, then the challenge here from my perspective would be, how do you manage fungibility? Because suddenly if I have a bunch of stETH that got minted from this validator, it's different from stETH minted by another validator because they might have different setups, different risk requirements, whatever it is. So you just describe how Lido now handles fungibility of stETH and if that's related to this bond.
Yes, so exactly. So, I mean, you're touching on a very interesting problem, right? So in Lido today, all stakers have, they have the exact same risk profile and they get the exact same reward. Right? And if there's a user, a staker who maybe has a different risk profile, maybe they want to take more risk and they want more reward. Okay. Then there's some way to implement that by using staked ETH today. So for example, you can loop it, right? Like you can leverage your staked ETH, kind of increase your exposure that way. But the options for doing that are relatively limited. Okay. Another example would be, well, you can like restake your staked ETH and like get kind of tap into maybe additional rewards that way. But the overall problem remains that there is no real way kind of to tune like the risk reward and like customize the setup exactly how you want it. Like some share of users may want Lido to go like very heavily into restaking. But then what happens to like the users who don't want that, right? And so that's why Lido in Regoose has made the decision that it is actually okay to add more validator sidecars, but only if they are very, very low risk. And, if they basically align strongly with Ethereum's, decentralization and kind of roadmap. So that's the decision that we made. So this is how kind of like a new sidecar, for example, could make its way into the existing Lido v2 and the staking router, like as a module, basically, right? But so we have established that we want to serve this much more kind of heterogeneous side of the market, right? And they can do that through the staking infra, and that is exactly where kind of the bond side of things comes in and the reserve ratio. So how do you allow people to use a different a different vault than the kind of the main Lido v2? And well, the answer is just that you apply a kind of a penalty. Like you would still allow them to mint staked ETH against that, but because they are taking more risk, they are more overall more risky than the main staking router. You allow them to mint a smaller amount of staked ETH, so you always retain some bond. And that's what the bond refers to. The bond is basically the access collateral that is sitting in the validator that is not encumbered or kind of like borrowed against in the form of staked ETH. Does that make sense?
It does make sense. So that sounds a little bit almost like an LTV model in a lending protocol. Is that an apt analogy to think about here? And I was kind of even thinking you could, depending on how you set this up, right, you could almost put the onus on the node operator to bring that capital, or you could put it on the borrower, right? So on the borrower side of things would be, hey, I deposit 1 ETH and I get 0.98 stETH back. And in the other sense, I could say, hey, I don't want the onus to be on the borrower here. I'm trying to maximize what they can get out. So instead, I want every node operator that's in this set to actually bring some amount of excess collateral so I can cover my users in the case that there's some sort of slashing event or any risk that I'm taking. Like, how did you kind of think through where to put the onus there?
Well, ultimately, go ahead.
So in general, I mean, first of all, it is a lot of design. Like in this space, like you can design staked vaults in different way. And what Lido is going to launch first, like is more simplified solution. First it can be an owner is a in general owner of the capital that can set up, and stake own capital. And then, like you can in general do some other work where you can choose who can, permission, for example, permission to deploy this capital, or in some other way. So in general, like it will be some customization. But what you should understand that if these are, like validation node, like for example, min stake these, like, and then produce, like more, like return rewards, like, then they can in general earn more returns by, I don't know, implementing some sidecards and so on. Then medium stake this, like if they are underperformed, then they will have a penalty because they get already, like this rewards through rebasing, like, and then they have some penalty from their collateral. But what this collateral also give to all stake these users is give a slashing protection. So if this validator slash, like, then, like it will be slashed from this, like, a bond, and it's make even system even more secure, like from slashing.
Mm-hmm. Awesome. Yeah, I'm curious, what was when you guys were looking at, I don't know, design inspiration here, what was some of the inspiration for you? Like, we talked a little bit about like the liquid staking module over in Cosmos, which this might rhyme with slightly a little bit, at least on the collateral management side of things here. But when you were looking at different inspiration here for the design of the protocol, did anything sort of stand out, or was it a little bit blue ocean for you guys?
Yeah, for me, like in general, I pushed the team already for 2-3 years. And in general, who are contributing to the design, but it's still, like a lot of such things can be in general design or delivered through models. Like in general, models and staked vaults is different design that can solve the same issue. Sometimes they even compete. I think, like staked vaults even give more freedom, like in customization and more flexibility. And we will see, like what different other even maybe restaking protocols and some other will build on top of it, like, so in general, it will make a lot of, space for creativity. And but of course it is design of stake wise, like they have stake vaults. It is a design of Cosmos and some other. But I think that when we get this idea, like initial idea on staked vaults, like it was a little bit before. It was before when we start to develop Lido V2, like with staking router and models, like we already it wasn't no examples, like back then. And but in general, because we already start to develop staking router and models, it was just the most simplest way to give more decentralization for Ethereum. That's why we prioritize, like to develop state models, make them stable, make some models with partners, like soon it will be, it is in some developments, like, and make it more mature, and then give, like the next phase that cover not only liquid staking, but you can just stake your ETH, build all your staking infrastructure, and if you need, stake this.
Yeah, I think shout out, I think, to all of those guys. Like, there's been a lot of inspiration, I think, to draw from. Personally, I think like what made it click for me, I've always been a big, lending markets guy, and so long-term kind of engaged with MakerDAO and so on. And there is a lens to which you can see already Lido. It is, taking ETH, putting it in validators, and then the validator is like 32 ETH, right? And growing because it's accumulating rewards, and you basically mint staked ETH against that, right? And you can imagine, in theory, that you don't need to put the same validator or like the exact same type of validator behind every staked ETH, right? Like, you can imagine there is maybe like a validator that doesn't exactly follow the requirements of Lido V2 and like the node operator management kind of procedures that we have, but that is using like something different. Hence, it is more risky, and hence you just still mint staked ETH against it, but you just mint it at a lower rate, right? Like, as you said, you apply like a different loan to value ratio, right? Like, if you want to use this analogy, which is a little bit of a stretch, but I think it can work. And so when you see it this way, then you realize really you're not limited by the types of validators that you can put. You can put different validators. You can allow stakers to really customize, and like market designers to really customize and kind of go crazy, right? You just have to kind of then tune the amount of staked ETH that can be minted on the front end, and thus keep the overall system always over collateralized and always in balance.
I really like this. It's it feels like this is sort of the future evolution of a lot of some of the early DeFi protocols, is this platformization and infrastructure layer. And I agree. I think one of the interesting components about this as well is the liquidity layer on top of it. And there's an analogy here somewhere. I don't really want to draw it out on this podcast to banking. Not that Lido's in any way, shape, or form a bank, but this idea of having a heterogeneous profile of loans at different banks and having dollars be fungible across different banks. It's is it all perfectly fungible? Like atomically fungible, and in practice, like I'm not 100% sure, but it works that way, over time. So there's maybe a little bit of an analogy there. Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional password management. Follow the link in today's show notes to get started with Ledger today. I want to talk a little bit more about this important segment of institutional stakers. Maybe we can start to break down, even just look at the 3 different actors that are in this market. And I would love to get a sense more on the ground of what do institutional stakers need. This was, I remember, one of the big challenges from the liquid staking season is that part of the challenge of interacting with the staking router at that time is that they didn't know who all of the validator set was. They didn't KYB all of the different whitelisted validators that Lido had. And now I would imagine a huge advantage here. And one of the big requirements has been now you can actually know exactly who your validator is. I know there's been a challenge as well around custody. A lot of funds especially have to bring qualified custodians. So can we kind of just walk through, I'm sure, the two of you have talked to many of these institutional stakers, and there's maybe some kind of checklist to go down, but what were some of the frictions that was preventing, this group from getting involved in the market to begin with? And, how do you expect that? Just let's go through that checklist.
Yeah, maybe I will start here. First of all, it is a lot of misleading information on the market, especially when, some companies who are trying to sell, to institutional clients, they try to, in general mislead, sometimes institutional clients, Lido is already used by about, a lot of big, it's the biggest protocols that's used by institutions, when we go into institutional clients, it's different regulation, different countries, that we need to understand. And for example, Europe, it is already some ETF providers. They try to build, ETFs with stake ETH, and in general, they already has, I think, regulation approvals, that can give them to, list ETFs with stake ETH. So it's no blockers. Lido V3 is in general not unlocked for them. They can use it already now. And it is a lot of other institutionals, that use it. Some of them, in general, they are just overcare, or it is different, or maybe it is different. It is a requirement, to in general, and in general, what they usually want, they want to understand, that the validators that provide the service, they are ready to, to have a particular uptime, in general, ready to work with institutional clients, and guarantee, by something, or the quality of the service, and in this case, with Lido V3, Lido can cover, that case where, the institution, any type of institution, ETF provider, or anyone else can, in general, choose a validator, choose a custody, choose other setups that they need, and in general, be sure that what they do is in general fully under their, setup they want to have to their clients, and one of the things here, when you speak with ETF providers, what they need liquidity, and even when you list, some assets on, assets are, that is, it should have some parameters of liquidity, and currently only stETH is cover all these parameters, of liquidity, if you will go into ETF, issuers. And I think that what is important to understand that, with that customization, even if some institutional providers has some really complex request, they can cover it and build it and be liquid at the same time. And that is a big benefit.
Yeah, on the ETF side, I guess we can say a bit more about why liquidity is so important to them.
Yeah.
In my mind, all ETFs are going to compete basically on one number. I mean, we know ETFs compete on brand and size, but a lot of people care very much about the total expense ratio that you basically incur when you invest. It would be ETF investors are very, very, very cost sensitive, right? And thus, if you're kind of an ETF provider, then you really are competing at driving the cost as low as possible, and if you want to invert this, the return as high as possible, right? And the way you do this with ETH is you want as much of your ETH in the fund staked as possible. You want that number, that share of ETH staked versus ETH non-staked, you want this as high as possible. And if you're only relying on the kind of primary market liquidity, which is provided to you by the Ethereum withdrawal queue, then there is only a very limited amount of liquidity that is available to you, because not the good times liquidity is what matters to these, but the worst time liquidity, right? When market is going down and a ton of people actually are selling off their ETF, and there's fire in the theater, right? How big is the door, right? Kind of to reuse this famous analogy, right? And so this is exactly where a staked, a liquid staking token is so much better than a non-liquid alternative.
Yeah, I can imagine. And what is the rough liquidity of when you're measuring that? Because the withdrawal queue is sort of the limiting factor here. What is the excess liquidity that roughly that stETH has in excess of that? How would you measure that?
Yeah, I will not give you the number, but the volume is about right now, I think it's about, 200 millions, dollars per day, so it's also, depends how you calculate it, we of course has dashboards, and because it is also stETH and wrap stETH, so, you can calculate liquidity for both. And but what we can definitely say is that it's that Lido is the most liquid token. Also, what's important for institutional, Hasu make a good point that they want to stake all is 100, because if you stake only 50%, then you get only 1.5% APR, and it's not make sense. In general, ETF providers want to stake them all, and then they need to have a liquidity during the day. So in general, it's the law, and they need to settle it, and if it is and it is no, other almost way, to instead of use stETH, and that's why all of them are interested, in making, in general discovering, how they can use stETH. Yeah, and also it is some regulation blockers. For example, in US, that staking is in general, state is not clear, and of course everybody is waiting this unlock, where SEC will give, stake is, to ETFs.
And one other piece that we don't need to go super in the weeds on, but I would love to get a sense as well of and I know this is a very heterogeneous group of depending on your geography and if you're a fund versus a large asset manager or an ETF or whatever it is, very heterogeneous bucket. But, when we talk about the MEV setup, so some of the sidecars that exist on ETH validators, can you just describe a little bit more, Hasu? You kind of kicked this episode off by describing, it's kind of like MEV Boost, I think still has massive market share, right? Something like 90+% market share, but there might be institutional setups that require more censoring or something like that for relays, or also we're getting a lot of different sidecars as well right now with things like pre-confirmations, etc. So you just describe the MEV infrastructure here as a component, and then is it mostly, do you think, going to be competing for, okay, I got to check my boxes to make sure there's some sort of censoring from my relay, or is it going to be competitive on yield? Do you think, if you onboard a bunch of different sidecars, like how would you describe that whole sort of sidecar environment?
Yeah, I mean, my main takeaway would be it's a little too early to tell. So as you were saying, like right now, MEV Boost in the sidecar market has 100% market share. There is nothing else. I know that some folks are working on Commit Boost, and that's the idea of making like a more modular version of MEV Boost. Although MEV Boost is also going to support pre-confirmations, for example, and so there are several different pre-confirmation sidecars that are being worked on, and these will in turn allow so different types of pre-confirmations, inclusion, execution pre-confirmations used for different types of validator commitments, like faster inclusion times for base rollups, for regular transactions on layer 1. Then you can, for example, implement block space futures this way, so you can pre-sell your block space. So let's say in 3 blocks it's your turn to make a block, you can already make an economic commitment that you are giving this block space to a certain party now, in the future. And then inclusion lists, for example, in theory can also be implemented in this way, right? Because you're giving an instant confirmation that you will include some transaction, and this in particular, building this inclusion list can be outsourced to a third party as a type of shared block building, right, or something like that. As we have seen, also DVT is an example of a sidecar. So really, it is a way of running a validator as a multi-sig. So you're entering this kind of agreement with other people, other operators on the same validator, and we have seen that there's many different permutations of these that people will at least try out. It's too early to say if anything will catch on in a big way. And yeah, going more maybe to the institutional market and side of things, what we have seen in some cases is that stakers want specific agreements, on as Konstantin was mentioning, on uptime, but maybe also on specific regulatory requirements around usage of relays and usage of builders that are OFAC compliant. So really, I think we're looking at a very heterogeneous market, and it's very early. I think some people are of the opinion that you will have a very rich space of sidecars, and different validators will use very different sidecars, and you will have many exist at the same time. I think I'm personally more in the camp that you will have a small number of sidecars kind of winning out. Why? Because these are all individually not that interesting if they don't get a lot of adoption, right? So you need a critical mass of adoption in any of these things for other people to build on services on top that really make use of these validator commitments.
Uniswap Labs is rolling out the red carpet and launching a $15.5 million bug bounty. This is the largest bug bounty in the entire history of crypto to anyone that can find a critical bug with the Uniswap v4 protocol. This bug bounty aims to make it the most rigorously reviewed code base ever deployed to Ethereum. Now, the Uniswap name is basically synonymous with security. $2.4 trillion in cumulative volume has passed through Uniswap v2 and v3. without a single hack. So Uniswap v4 is dedicated to bringing that same level of security and transparency to the v4 protocol. So if you want more information or eligibility or scope or rewards or payout or any of that good stuff, there's a link in the bottom of the show notes. I highly recommend that you stop listening right now, go to the show notes, click the link, head over and tell them that I sent you. Start earning money today. This episode is brought to you by Morpho. Morpho is the first and only DeFi protocol Coinbase has integrated directly into their main app, giving millions of users access to borrow against their Bitcoin on Coinbase. Just as Web 2 companies like Google, Amazon, and Meta were built on internet protocols, the largest financial companies of the future, such as Coinbase, will build on decentralized protocols like Morpho. Whether you're an individual, fund, fintech, or institution, Morpho is for you. Follow the link in today's show notes to try Morpho today. I would also guess, and Konstantin, I want to kick this over to you and actually maybe ask a little bit of a tactical question about how you're approaching things from or how Lido might be thinking about things actually just from like a BD setup standpoint here now. But one of the other things that occurs to me as well in this sidecar adoption thing is that the vast majority of stake, I would guess at this point, is professional staking companies on Ethereum. And so I'd imagine it's not maybe as difficult as a BD job as it used to be to get a large percentage of stake. And that also, Konstantin, I'd be very curious to get your thoughts about how Lido might approach BD in this new environment, because now that you have a much more heterogeneous group of, you used to call them modules in the staking router, but now just vaults. I could imagine a large percentage of TVL moving onto the platform being from a small set of big depositors. That could be eventually like ETFs, but it could also be even DeFi protocols like Maker, right? Where now you have the ability to create much more custom, essentially, agreements for large holders of ETH. And so to me, this kind of looks like something that's transitioned from something that made more sense to have kind of a marketing setup where you had mostly like a retail consumer base and it didn't make sense to have an institutional BD setup, now to something that probably does require more of a BD than a marketing setup. And I would just be curious operationally how you might think about that.
Yeah, that's a great question. I think that's the same questions that the community asks in Ethereum, like how you will do BD for Ethereum,
Yeah, that's what I was kind of thinking actually too.
I think, first of all, what I try to say to everyone is that, to build a centralized project is hard, for example, I think EF have, great execution, now, and I'm really fan of EF, but it still has problems, why? Because in general, it was different regulation environment, where you in general were super careful and wasn't so, and a lot of protocols were scared, because it was attack on crypto founders, attack on crypto projects, and it was super, bad time for good projects, not for bad one, and now the regulation change, EF, for example, start to be more proactive. I think on Lido side, for example, my vision here is close to Ethereum. You need to create a platform, and you need to make, different companies who built on top of it, profitable to make BD and sell this platform. For example, with Ethereum, we have a lot of L2s, a lot of different DeFi protocols that in general, I like this thesis. Ethereum has hundreds of BD teams, Same as for Lido. Lido is building marketplace, as you mentioned in the beginning, and if you make it customizable and profitable for a lot of participants, then they will make BD for you. And what I can try to say, if in general, BlackRock or any other ETF provider will choose a validator, they still will choose a validator that they are okay to go, who in general cover all their, request. And this validator can use Lido in general infrastructure and provide what these ETF providers want, liquidity, and in general be the BD power of Lido. So the big power of it that a lot of different participants can find beneficial to use Lido infrastructure because it's make staking more simple. It's in general make it more decentralized. In general, this institutional, maybe like large ETFs should think that this Ethereum price will be higher if Ethereum will be decentralized, because if it will be centralized by 4 participants, it's just a database and it's price 0. If it will be decentralized, like then it makes sense to call it as a world computer. And for me, like I think the best BD for Lido is in general build this layer where different parties can compete and be successful and earn rewards, like from the protocol, and make it sustainable. Because I don't believe in like businesses, foundations, or like any economical activities that it can be non-efficient. Like in general, it should be efficient. I believe in general cybernetic economy, but it's another topic. And motivate different parties, like to stake using this infrastructure. I can give you example. Like for example, we have EF, Ethereum Foundation, and maybe they are not ready now to stake.
The first or the second Ethereum Foundation?
I mean, let's talk first about the first other five, and I think that what is important that they are not maybe ready to stake with Lido. Why? Because of some, like in general, they want to stake maybe with solo stakers and some others.
Sure.
And what Lido can give with staked vaults, like first of all, choose a validator. For example, it can be guest team or like some other, for example, developer of their, a client team, like that already, in general, they already staking provider for Lido, and in general, Ethereum Foundation can stake with them and be sure that they get some fees, that they even can manage these fees to validator. And maybe they want to donate these fees, like from stake this to some project. Or they can want to have a censorship resistant setup, and in general, I mean, they can make Ethereum more decentralized by using this infrastructure. So Ethereum Foundation is one of the clients that in general, what Lido do is solving the issue. It's outsourcing the Ethereum issue of staking, because now Ethereum or researchers, they, for example, proposing rainbow staking and some other type of the staking. In general, with staked vaults, you can build it. In general, staked vaults solve the issues that you can stake with low bond. You can run different setups. You can use restaking inside, and a lot of different other creative things that you can do. And maybe Ethereum need to focus more on scaling, or some other questions. If in general, like the problem of staking is solved. And for us, like if we will build their like middleware, the software with the right incentives, then BD, or your other, then you need education, like to educate in general different staking providers, different, like for example, client teams that they can stake with EF and donate in general to some funds, like that they want. So in general, you make it healthy infrastructure and you build a game theory that do BD for you.
Yeah, I think that talked about, we had Paul from Morpho on the podcast maybe 2 months ago, and we were describing maybe like what he described as a B2B2C model, and maybe there's some element here as well of, right, if you're the neutral underlying infrastructure on the bottom, then you do rely on someone that has more direct relationship with your customers or depositors, which is a little bit of a change in Lido's model here. So I've got a question for you guys as a hypothetical. One thing that might be interesting in Hasu, I think I asked this the last time we recorded, but I could imagine, so for instance, someone that does not do native staking or not do liquid staking, but they're a large staking pool like Coinbase. Like what if Coinbase was like, hey, and they're doing this with Morpho currently, like I've got a bunch of people that are staking currently. I would like to take advantage of this neutral infrastructure and the liquidity of stETH, because cbETH didn't do particularly well. I think it's roughly a dead product at this point. And say, hey, I actually want to take advantage of this neutral infrastructure, and maybe I want to mint stETH, but maybe I also want to mint my own liquid staking. So how would you approach both of those decisions? And I could ask the same thing, by the way, about any of the other staking providers. You could like do Rocket Pool or whoever, but how would you guys feel if some of the other staking pools approached Lido to use this infrastructure?
Yeah, in general, like that is their in general, why we designed this infrastructure, because we want to have more open market, like in general. I mean, even our Coinbase can, like, first of all, earn more if they, in general, like use some type of not leverage, but in general, if they use some type of collateral and be more ease, like they can earn more on collateral. And also, I mean, they can mint stake these, like, and in general have tried to build better product, like that is one of the use cases that I think we are targeting. That if like Coinbase is not so liquid, they can utilize that infrastructure and utilize this liquidity, and that's benefit both, like, and this customization, like, but finally, like the adoption will be of the most secure solution, because like, I mean, when people stake, they try to like eliminate the risk, and all this, I mean, how to say, different providers and different setups will make staking more decentralized and will make it more secure. And I think that different LRT protocols, different exchanges, different other, like DeFi protocols, they can utilize this infrastructure to run own staking, or like to mint stake this, both.
And then follow-up question would be, what if, I'm Coinbase, I would bring a massive amount of, ETH onto, and eventually probably liquidity into the Lido ecosystem here, but I don't want to mint my own, I don't want to mint stETH, I want to mint my own liquid staking token. Like, so essentially be a whitelisted service. How would you think about that as a business opportunity?
I think, like, first of all, you need to fork, I mean, I think stake walls to, in general, make all the setup. But and I think it's great, like, I mean, if you will build, I mean, the same with Morpho, you can fork Morpho walls, like, and also build your own product. I mean, I think it's great about crypto that, like, I mean, it's in general open code. Why? Because it's a blockchain, because you need to trust it, like, and open source code. And I mean, everybody benefit from it. But I think that eventually, like, for Coinbase, if they even use this infrastructure and mint own tokens, they need still to build this liquidity. And I think they can get more benefits by utilizing, like, take this, like, liquidity and merge it, or get the best from stake this. They can in some way build their own token on top of stake this and have a better product.
Got it.
Yeah. I mean, I would say it's not really something that we're thinking about very much, because it doesn't make a ton of sense, right?
Yeah.
Like, you can, the benefit of, I mean, a lot of the benefit of using the Lido staking infra is that you get the access to liquidity whenever you want, right? This really, this is the liquidity layer is the differentiator, right? And like, if you don't need this, then you can still use the infrastructure, but we're not going out of our way in order kind of to facilitate or like encourage that. It doesn't make a ton of sense. And this is, you asked like earlier about like BD, what the BD focus should be, right? And so, I mean, I just want to highlight again, like, that on the vault creation side, like, we're really seeing a kind of change, like, from a to consumer type of business to like a to business to consumer type of business.
Yeah.
But, and this is the one thing that I wanted to add to that discussion, is the staked ETH liquidity and integrations. That remains the other huge, like, other side of the coin. And so for Lido, it will always be of utmost importance to like make sure that staked ETH is the most liquid staking token, and that it's integrated everywhere, it's available everywhere. And then you make it like really attractive to build vaults on top of Lido V3.
All right. Very helpful. So one thing that we didn't really talk about, I just kind of want to touch on, as we sort of start to wind down here, is this kind of like this new asset management curator type market. And I would love to get a sense as well of who you envision that being. When I look over at Morpho today, it's sort of like the steakhouses of the world, it's the gauntlets of the world, etc. So is that roughly the group that we see here as the initial curator set, or do you see a more like TradFi sort of curator set? And I would be curious because we talked a little bit about structured products here, and we haven't talked about like the leveraged looping use case for vaults in general. But two-parter, I'd be curious who you see as the initial curators here, and then what are some of the early versions of structured products that you see being built on top of or that leverage stETH?
Yeah, first of all, like I think that the curators are all the same, like they on the market, they work with different, like protocols, they work with Melo, they work with, like Morpho and some other protocols. And sometimes it's validators by themselves, like, I mean, it's still a question, like of regulation, like because curators sometimes can have, like more risk of regulation. And in this case, like still it will be fully self-custody product. Like and also like I mean what Lido can do, it can adopt like their vaults to some other vaults. For example, like you can see a Melo vault, like where a user deposit is, it's staked in Lido vault, and some of it's in general looped, like and get more APR, and at the same time like part of this is can be restaked in like eigenlayer or symbiotic, like protocols. And in general, I think that it is a protocol for structured products like Melo that give you this way to manage your position, and it will be a curator there. What is, like Lido is under layer, like for liquidity and for staking, like particular, like, and then, I mean, yeah, it can be utilized in case of some curators from like traditional market. I think they eventually will come because like we all understand that all the assets will be on chain long term, like, and it will be a lot of interest from traditional markets to figure out how to work with these markets and adopt this infrastructure. And I think that staking infrastructure will be adopted first, and then we will see more complex products, like that can be built on chain.
Yeah, not a ton to add to that. I mean, curators in my mind, I mean, yes, like you can have the curators that exist today, but like they can be yield protocols, they can be LRTs, they can be institutions, and they can also be existing node operators. So like from talking to them, like if you look at, look, we talked in the beginning about this bifurcation of the market and like liquid staking and non-liquid staking, right? And a lot of the same node operators, for example, that operate in Lido in a liquid staking manner, they also have other clients outside of Lido in a kind of non-liquid market, right? And we found that they can also benefit from bringing that stake to Lido, and they can offer the exact same terms to their clients inside Lido that they can offer outside. So for example, they can have lower fees, they can have, restaking, custom setups, all kinds of things, but they get the liquidity for free, right? And they can use the liquidity to further drive down their costs or give like more rewards to their users, right? And so if you're anyone who has existing customers in the staking market, and they are not currently making use of any liquidity, then you can bring that stake also to Lido and benefit.
Got it. Okay, guys, I know we're running a little bit low on time here, and you guys have already been super generous. I guess just like logistically here, so we're talking on a very interesting day. We're sort of announcing all of this. Can you guys give any details that you can share in terms of a timeline for sort of next steps, or when people can dig into more technical details, or kind of just phases of this rollout here? Like, just maybe cover some of the logistics.
Yeah, I mean, first of all, I think that the goal is to go fast, like, and it will be some pre-launch soon in a week, I think, or maybe like a little bit more. It will be announced forward, like, and then it will be a test net, like where like different providers and curators can try already the technology, and then it's still, difficult to predict, development, because it really has a lot of dependency, especially audits, and security is the most important thing, and then the mainnet is planned during the summer.
Excellent. Okay, guys. Well, look, this was really fun. And, Lido and liquid staking in general is one of my favorite subjects to nerd out on. So I really appreciate both of you coming on. And if you are a potential institutional staker or a node operator or depositor, and this all sounds interesting, where can people find out more?
Yeah, first of all, it is a special, website, especially for Lido V3, you can in general join it, and it is a way to communicate with the team who is building it, to in general to be onboarded, in the first wave, to the first wave of validators, curators, and institutional clients. So if you're part of that, we also can share it with you. Maybe you can add it, in a podcast or somewhere else, it is a channel that you can join and start to be the first, to be in the first wave of, people who want to build on Lido V3.
First wave, baby. I love it. Guys, Konstantin, Hasu, really appreciate both of you joining, and we'll have to do this again sometime soon.
Definitely. Thank you very much, Michael. It was amazing.
Yeah.
That was a lot of fun. Thanks, guys.